Good morning. I'm Rick Nelson, Chair of the Budget Finance and Audit Committee for HOC. This is our meeting of April 14th. And to my left is Commissioner Kelleher, and we're joined by Executive Director Chelsea Andrews and other staff. First item for on the agenda is the approval of minutes of February 17th. Do I have a motion?
I move that we approve the Budget and Finance Committee meetings for February 17th.
Yep, this is Jamal speaking.
Hi, Jamal. It's Lynn. How are you?
Not having another member of the commission present, I will second the motion. All in favor, say aye.
Aye.
Aye. So the motion is approved. And we will begin today's presentation of the 24 budget, particularly the general fund, with Executive Director Andrews.
Thank you, and good morning, commissioners, members of the public, and HOC staff. At our board meeting last month, we had an opportunity to provide a high-level overview of the recommended budget. Over the course of the next two budget, finance, and administrative meetings, we will break down in more detail the various funds, allow for opportunity for feedback and questions from this committee, and take that feedback as we prepare the final recommendation to go before the board in June. I'd like to turn it over to our finance team led by acting CFO Tim Getzinger to provide us with an overview of the first fund, and that's the general fund.
Thank you, Executive Director Andrews. For the record, Tim Getzinger, I'm the acting CFO, as well as the Chief Development Funds Officer. Good morning, Commissioners. Today we will begin our discussions of the FY 2024 recommended budget and introduce any changes that have occurred since it was presented on April 5th. In this morning session of the Budget Finance and Audit Committee, Terry Fowler, HOC's Budget Officer, will present the review of the FY 2024 recommended budget for the general fund. Following the general fund, Vivian Eco-Rowe, financial analyst, will present the review of the FY 2024 recommended budget for the public fund. The presentations will include a discussion of any changes that have occurred and their impact on the budget that will be presented for adoption on June 7th. As mentioned in the April 5th meeting, budget staff has been hard at work finalizing the recommended budget book, which is expected shortly. And Terry Fowler will take it from here. Terry.
Thank you, Tim. Good morning, commissioners, and thank you, Executive Director Andrews. In today's meeting, as stated, we will review the FY24 recommended budget, and we will begin with the general fund. If we can move to slide 12 of the packet. At the April 5th Commission meeting, we presented a balanced budget of approximately $331.8 million. Please note that the budget is balanced with a projected draw of approximately $1.56 million from the general fund operating reserve. And our discussion in this packet will focus on the general fund. Moving to page 13 of the packet. This chart reflects the source of funds received in the general fund. As in past years, fees for agency overhead are $12.74 million, or 41.93% of the total revenue in the fund. They do not fully cover the budgeted overhead expenses as a result of restrictions for some of our properties, grants, and the OHRF, leaving approximately 57%, or $16.65 million of overhead to be covered from other revenue sources in the general fund and unrestricted cash flow from our non-development properties. Development corporation fees, which are the cash flow taken from those properties, is approximately $6.04 million, or 19.88% of the revenue. Depicted in the gray area are the fees for services that are generated by real estate and mortgage finance, and they represent $7.1 million, or 23.37% of the revenue in the general fund. Transfers between Funds account for another 1.86 million or 6.11%. FHA risk sharing, which is the income received by the properties and then restricted to that reserve, represent 1.08 million or 3.56%. And there's a small amount of other income totaling $6.95 thousand or 0.02%. And finally, you see the projected draw from the general fund operating reserve of approximately $1.56 million or 5.13%. We'll now move to slide 14, and this chart reflects the distribution of expenses by accounting group. Personnel cost, which is consistently the largest expense in the general fund as it is comprised of the majority of overhead, is 24.27 million or 72.1% of the expenses in the general fund. Operating fees, which include audit fees, building rent, bank fees, and other vehicle payments, is approximately $677,000 or 2.01%. The operating administrative costs in the general fund represent $4.23 million or 12.5%. And other operating, which includes tenant services, security contracts, utilities, insurance, is budgeted at $761,000 or 2.2%. The maintenance expense that you receive on the chart, which is approximately 1.5 million or 4.44%, represents the maintenance costs for the Dietrich building, the Easter Park building, our service centers, and our contract maintenance contracts for IT. And finally, the non-operating expenses comprised of the contributions to the FHA risk sharing reserve, funding for IT and facilities capital, debt service payments, contributions to replacement reserves, and budgeted contributions to the general fund operating reserve and opportunity housing property reserve are budgeted at $2.23 million or 6.62%. Moving on to page 15 of your packet. This chart depicts the general fund operating reserve, the current sources and uses, and project
the screen up to where you are.
Yes, we're on page 15 of the packet. Thank you. It shows the projected balance based on the plans for fiscal years 2023 and 2024. For 2023, there is a prior period contribution from the FY 2022 year-end surplus of approximately $506,000. There's a projected budgeted contribution of $250,000 from the FY 23 budget, and projected interest income of approximately $169,000, which is significantly higher than the interest we have been earned in prior years. There are also projected draws of approximately $988,000 to balance the FY 23 budget, $242,000 for the actual FY 22 Metro Point operating deficit, and a projected draw of $244,000 for the projected deficit on Metro Point for FY 23. For FY 24, there is a budgeted projected contribution of $250,000, projected interest income of approximately $169,000, and projected draws of $1.56 million to balance the FY 24 budget, and $127,000 for the projected FY 24 Metro Point operating deficit. The net effect is a projected decrease of approximately $548,000 in FY 23 and $1.27 million in FY 24, with a projected balance of $7.6 million for June of 2024, which is 4.8% of the adjusted operating budget net of bond programs, housing assistance payments, and grants. We can now move to page 16 of your packet. This chart depicts the FY 2024 capital budgets for our facilities and IT totaling $800,000, which is down from the FY 23 budget of $1.087 million. The facilities and IT budgets are projected to be funded by the replacement reserves and a $350 draw from the operating budget, which is down from the draw planned in FY 23 of $787,000. This concludes the general fund portion of the presentation, and I'll be happy to address any questions you may have before we move on to the public fund.
You have any questions for me? Go ahead. Go ahead.
Good morning, Commissioners. My name is Vivian Cole, the Financial Analyst with the Budget Office. We will now review the FY 2024 recommended budget for the public fund. If you can please go
Can
to.
you speak up a little bit, please?
Sorry. If we can go to page 23 in your packet. As Terry stated, the agency FY 2024 recommended budget as presented to the Commission on April 5th was approximately $331.8 million and was balanced with a draw of approximately $1.56 million from the General Fund Operating Reserve. This budget has not changed based on the General Fund presentation, so we will now move on to the public fund. If you can go to page 24 in your packet. Thank you. This chart depicts the 5-year history of the Housing Choice Voucher Program. Changes from FY 23 amended to FY 23 recommended budget. From FY 23 amended to FY 24 recommended budget, we have increased the Housing Assistance Payment HAP funding by approximately $10.9 million due to increased utilization. Administrative fees income increased $1.13 million based on a higher proration factor of 89% from HUD, as well as increases in utilization. On the expense side, personnel expenses increased by $1.05 million. The operating fee expense increased by $59,000, and the HAP expense increased by $5.8 million. The net effect results in the removal of contributions from the HAP reserves position of $4.89 million and contributions from the admin reserves of $122,000. In addition, we're projecting contributions of $179,000 and $133,000 to the HAP and admin reserve, respectively. If we can now move on to page 25. This chart shows the distribution of non-HAP expenses. Personnel totaled $7.08 million, or 66%. Operating fees totaled $2.07 million, or 19%. Other administrative expenses totaled $1.54 million, or 15%. We can now move on to page 26. This chart depicts the federal grants. We're not currently planning on supporting agency operations from the Capital Fund program. Therefore, have not budgeted this program for FY 2024. The Fatherhood Grant is in the 3rd year of a 5-year period with annual funding of $999,000. The McKinney Grant budget assumes a $4.3 million budget, which is a decrease of $225,000 less than what we received in FY23. The ROS grant, which funds our family self-sufficiency program, assumes a budget of $547,000 for FY24, reflecting an increase of $50,000 to support a larger portion of the existing work years. If we can now move on to page 27. The chart on page 27 depicts the county grants. The county contract increased $339,000 or 4.4% from FY23 based on projected increases in personnel costs due to the estimated salary benefit adjustments for FY24, an increase in rental license fee funding based on projected 10% increase in the fees charged, and the addition of fees for Battery Lane. The closing cost funding has increased $15,000 based on estimated salary and benefit adjustment for FY24 and the corresponding management fee expense. Funding for the recordation tax programs was held at the same level as FY23 based on the reduction in recordation tax income to the county. These programs include the Rent Supplement Program, Move Up Initiative, the Community Choice Homes Initiative, and the Youth Bridge Initiative. The McKinney funding increased $12,000 or 1.7%. And our miscellaneous funding decreased $6.4 or 1.7%.
Can I ask a question?
Yes.
Question, please. On the recordation program, the county executive has requested an increase in his budget for recordation. Is that affect these funds, or is it directed to other programs?
We have not been given an increase. I don't know if there will be a change subsequent to the numbers we've already received, but our funding was held flat and we have not been informed of any increase to the programs that we have that are funded by recordation tax. But we will contact DHAA to determine if any changes are forthcoming, and if they are, we will amend our budget accordingly before presented in June.
And I guess I've missed, I'm not sure I remember what Move Up initiative it is. Does anybody know? Or the Community Choice Home Initiative? Or the Youth Bridge Initiative? Those three are, I just don't know what they are.
I believe resident services could probably answer this more comprehensively, but Move Up typically are circumstances where an individual who was previously experiencing housing instability has transitioned to a stable environment, and it is a bridge as they move into that next phase, and has reduction in terms of case management wraparound, but still provides some level of rent supplement in the interim. And that's the term that's used in the homeless sector. And I know we provide resources and support in that space. So my assumption is that Move Up is that, as well as Youth Bridge initiative is probably also for young people experiencing homelessness. But I can inquire and get back to you with more details on those programs.
Director Andrews, I actually have a file that can provide additional information.
Thank you.
And the Move Up initiative is correct. You must be a county resident residing in permanent supportive housing program within the homeless continuum of care, and they are referred by the Department of Health and Human Services. Their income is not to exceed 60%, and they cannot be receiving other federal subsidies such as the Housing Choice Voucher Program, and then they pay 30% of their income. The Youth Bridge Initiative is for children aging out of the foster care program and are also referred by Health and Human Services. Same restrictions apply, that income is lower than 60% of the area median income, and not receiving any federal subsidies. The community choice homes is for Montgomery County residents who are non-elderly and disabled. They're referred by the Maryland Department of Disabilities, or the money follows the person bridge subsidy program. And again, they pay 30% of their income for the housing. And during FY23, there was a redistribution of some of the funds that were not being spent in the rent supplement program to be moved over to the community choice program to assist with that funding.
So if the president's proposal that everyone coming out of foster home get a voucher, HCV voucher, then this program for Youth Bridge may essentially not continue to exist, I would think. It's the first time that a proposal has been made for an entitlement program for vouchers in this year's president's budget. So we'll see what happens with that.
Yeah, and if that would occur, we would look to redirect those funds to an existing population that needs further assistance.
Right.
Are we restricted from redirecting those funds?
No, we have done that over the years. When the funding and recordation tax was increasing substantially over the years, that's when the development of these programs came into being. And as each year goes on, we look at the need and in each of the programs, and we have also redirected some unspent funding to assist with the rental assistance of our customers that due to COVID were not able to make their rent payments. So we do look annually at the use of these funds to make sure that we are using them in an effective way to use them to the best of the ability and fully spend the funds.
Okay. Thank you.
Thank you, Terry. This concludes the public fund presentation, and if there are no further questions, I will turn it back to Terry, who will tell you what is coming up in the next BFNA budget review on May 12th. Thank you.
Are there any other questions related to the two presentations this morning?
Overall, I'm noticing that there's about an 8% increase in the budget, not specific necessarily to any of these items. And that's understandable given where inflation has been, particularly in costs for personnel and some other things. But that always makes me nervous about how, let's say, how accurately we think we can project our revenue. Expenses, I always feel like we have more control over expenses than we do over revenue. Are we fairly confident in the way we have shown revenue in here that it's actually realizable?
So there's a couple things on our revenue. One, more than a third of our revenue is government funded. And we are told by the government what they are going to provide. The majority of that is for our housing choice voucher payment.
Right, the HAP program.
And for our HAP payments that were projected at about approximately $124 million. That money goes directly to the landlords in the program. We did see an increase from the county executive voluntary rent guideline this year, going from 0.4% to 5.8%, which is a reflection of the inflation that you mentioned. We are projecting to increase our rents by that, and we are doing what we can to assist our residents to get back on track with rental payments to help us with the revenue. Very little of our revenue is really discretionary that we can control.
Right.
And then in addition to rents, which make up about a third of our budget, and the grants, then we have the fees from our development and financing and real estate and mortgage finance. We will be meeting with both of those teams between now and the May 12th meeting to review the fees we have in the budget and see if any substantial changes have happened in those plans. We will also be meeting with property and asset management to determine the impacts of the rental assistance that has been applied and is continuing to be applied to our arrearages, to determine if there's any significant changes that we can anticipate in the bad debt that we are projecting for next year. those rental assistance payments coupled by our lease enforcement that began in March, it is our hopes that we can start steering our revenue back where it is discretionary into a more stable source. And we will inform the commission of any substantial changes that we anticipate for the budget that comes in June at our next meeting, which is May 12th. When COVID began, we did our best to estimate what the impacts were going to be, and no one could have really predicted the depth of the impacts or the length of the impacts. I believe that we will bring our best budget forward in June, but I do anticipate that as we work our way out of the arrearages, that we'll be bringing you a budget amendment later in the year as we can fully see what the impacts of rental assistance and lease enforcement and the new higher rent increase, how they are impacting our revenue.
Okay, I appreciate that. It sounds like you're very much on top of it, which is not surprising given your history, but I appreciate that reassurance, especially since it appears that we will be drawing down on reserves a bit more than we have in the past. I just wanted to make sure that our revenue was going to be there so that we didn't end up in a problem with lower reserves and lower revenue.
And one note for that, we are projecting to draw from the reserves, but it was noted in your packet in prior years where we've had a projection that we would have a need. At year end, we did not have to draw from those reserves. It is dependent on our revenue, and there's timing related to that revenue, especially as it relates to fees, where you get the development fee, but the timing may be slightly off. So it is our goal to bring a budget that is balanced. It is also our goal to hopefully not have to draw on reserves, but that's why they are there. And we knew we were going to need to increase those reserves over the years because of the impacts that we've had recently with COVID and inflation and getting us through this period of time.
Right, which is exactly why it's worth putting funds in reserve and not spending every penny you've got.
Yes.
And I appreciate your conservativeness over time in doing that. Thank you.
Any other questions?
No, that's mine for the day.
Okay.
We will see you on May 12th.
All right.
Thank you,
Thank you.
commissioners.
And we will get you this budget book very shortly.
Okay, thank you.
Thank you.